the silver-copper shortage that Wall Street isn't talking about. Right now, two contradictory statements are both true. There is a silver shortage. There's not a silver shortage at the same time. Somewhere between those two statements is a mechanism most investors have never heard of, a mechanism buried inside a market you don't even think about. Copper. Because what is happening to copper right now is not a coincidence. It is a warning. And if you understand why copper is breaking, you will understand exactly what is coming for silver next. Before the headlines catch up, before the price catches up, stay until the end, because the connection between these two metals is about to become impossible to ignore. Welcome to Currency Arc Insight, the channel dedicated to decoding the economic signals that shape real wealth before they reach the mainstream. If this analysis adds value to how you think about markets, consider subscribing so you never miss a strategic briefing like this one. And before we begin, let us know in the comments where you're watching from today. In the world of precious metals, two experts can look at the same market and reach opposite conclusions. One says there is a silver shortage, another says there's not. Both of them are right. This is not a contradiction. It is a sign that most people are asking the wrong question. To understand what is really happening, it helps to start with a simple fact. Silver is not rare like gold. It is far more common, but it is also far less abundant than copper. This puts silver in a strange middle position. It is scarce enough to matter, but common enough that people assume supply will always keep up with demand. That assumption is now being tested. The silver market has run a deficit for 6 years in a row. This means the world has used more silver than mines and recyclers have been able to produce. According to the Silver Institute, the gap for this year alone is projected near 67 million ounces against total global supply of just over 1 billion ounces. That gap has been quietly covered by drawing down stockpiles that were built up over decades. Those stockpiles are large, but they are not endless. Every year the buffer gets thinner, even if nobody notices the change day to day. This is the part most headlines get wrong. A shortage does not always mean empty shelves or empty vaults. Sometimes it means something more dangerous, a slow and steady drain that builds pressure underneath the surface, invisible until the moment it is not. To understand why this deficit does not simply fix itself, it helps to look at where silver actually comes from. Most people imagine dedicated silver mines pulling metal from the ground on demand, but the truth is different. Only about a quarter of the world's silver comes from mines built specifically to produce silver. The rest, more than 70%, comes out of the ground as a byproduct. It is pulled up alongside copper, lead, zinc, and gold, almost as an afterthought of those other mining operations. This single fact changes everything. It means that even if silver prices rise sharply, miners cannot simply dig faster to produce more of it. Supply is tied to decisions made in the copper, lead, and zinc industries, not in the silver market itself. Price incentives that would normally fix a shortage in most commodities do not work the same way here. At the same time, demand for silver keeps climbing, and much of it has nothing to do with jewelry or coins. Silver is essential to solar panels, electronics, electric vehicles, and the data centers powering artificial intelligence. This is industrial demand, and it does not pause when prices rise. Factories still need the metal to build their products, no matter the cost. So, while supply is slow and structurally limited, demand keeps pulling harder in the other direction. This is where the real danger begins to take shape. It is not about vaults running empty overnight. It is about a widening gap between what the world needs and what the world can actually produce, quietly building for years, hidden behind normal-looking price charts. And there is one more piece to this puzzle, a piece almost nobody is watching closely enough. Since most silver rides along as a byproduct of other metals, especially copper, then whatever happens to copper does not stay contained to copper. It ripples outward. It reaches into the silver market, whether investors are paying attention or not. Right now, something unusual is happening to copper. Its price is climbing to record levels. Its supply chains are under visible strain. And if the connection between these two metals is as tight as the numbers suggest, then what is happening to copper today may be the clearest early warning of what comes next for silver. That connection is where this story turns next. To understand why copper's record highs matter so much, it helps to first understand what a shortage actually looks like inside a modern metals market. Most people picture a shortage as something physical, empty shelves, empty vaults, nothing left to buy. But in markets like silver and copper, the real danger hides somewhere else entirely, in a gap between paper and metal. Here's the part almost nobody explains clearly. For every ounce of physical silver that exists, there are many more ounces traded on paper. These are futures contracts, unallocated accounts, and other financial promises that represent silver without anyone actually holding it. Most of the time, the system works fine. It creates liquidity and lets the market function smoothly. Problems only begin when a large number of paper holders decide they no longer want a contract. They want the real metal in their hands. When that happens, something called a squeeze begins. A squeeze is not about the world running out of silver. It is about settlement stress, a sudden mismatch between how much metal people are demanding and how much is actually available to deliver. Prices can move violently during a squeeze, long before any vault comes close to empty. This is why silver can sit quiet for months and then explode higher in a matter of days. There's a way to see this stress coming before the headlines catch up. Analysts watch two major storage systems closely. One is COMEX in New York, home to futures trading. Silver held there is divided into two categories: registered silver, which is pledged and ready for delivery, and eligible silver, which sits in the vault but is not currently promised to anyone. The other major hub is the London market, where most of the world's physical bullion is actually stored. But here too, a large portion of that metal is already spoken for, locked into ETFs, central bank holdings, and client accounts. What actually matters in a real squeeze is not the total metal reported, but the smaller slice that remains truly free to move. There's also a subtle signal that most casual observers completely miss, something called backwardation. Under normal conditions, metal for delivery later costs more than metal for delivery right now. But when physical supply gets tight, this flips. Buyers become willing to pay more for silver today than for silver next month, simply because they do not want to wait. When this shift happens, along with rising costs to borrow physical metal, it usually means the market is quietly admitting that available supply is thinner than the headline numbers suggest. This is exactly why copper deserves so much attention right now. In recent weeks, copper prices have surged to record highs, driven by a sudden spike in imports and a sharp drop in exchange inventories. This is not simply a story about global growth boosting demand everywhere. It is a story about deliverable supply tightening fast in specific locations, exactly the kind of stress signal explained above. And copper's connection to silver is not just theoretical. As explained earlier, most of the world's silver output rides along as a byproduct of other metals, and copper mining is one of the largest sources of that byproduct supply. When copper supply chains tighten, when mining economics shift, when copper producers slow down or scale back operations, the ripple effect does not stay contained. It reaches directly into how much silver actually reaches the market each year. This is why seasoned analysts often say the same thing: watch copper to understand where silver is heading next. The two metals move through very different industries and very different headlines, yet underneath the surface, they are tied together by the same mines, the same supply chains, and increasingly the same warning signs. What copper is showing the world right now may be the clearest signal yet that the pressure building beneath the silver market is not slowing down. It is accelerating. History does not repeat itself perfectly, but in the silver market, it rhymes often enough to pay close attention. To understand what may be coming next, it helps to look back at the moments when pressure like this has broken loose before. The most famous case happened between 1979 and 1980. Two brothers attempted something almost unheard of. They tried to quietly buy up enough physical silver to control the market itself. This is different from a typical squeeze. It is called a corner, and it requires one buyer or a small group to deliberately gain control over the deliverable supply. Their attempt pushed silver close to $50 an ounce before the effort collapsed under new trading rules. It remains the only true cornering attempt in modern silver history. Most modern episodes look different. They are not driven by one mastermind with a plan. They are driven by a crowd, thousands of buyers reaching for physical metal at roughly the same time, often triggered by a single news event or a wave of attention online. In 2021, a social media movement pushed retail investors towards silver all at once. Premiums spiked. Demand for physical coins and bars surged. It did not fully break the market, but it revealed how quickly sentiment could turn into real pressure on deliverable supply. Then came early this year, when the pattern repeated on a much larger scale. Silver moved out of the $80 range and kept climbing, eventually reaching an all-time high just above $121 an ounce. Shorts who had promised silver they did not physically hold were forced to scramble, some buying back positions at a loss, others racing to source real metal that simply was not easy to find. Reports also emerged of at least one large buyer choosing to take physical delivery rather than settle in cash, adding further strain to an already thin market. What makes this moment different from past squeezes is the structural deficit sitting underneath it. In 1980, and even in 2021, the underlying physical market was not necessarily starved for supply in the same persistent way. Today, 6 consecutive years of deficits have been quietly draining stockpiles that took decades to build. The cushion is thinner than it has been in a long time, which means the next moment of pressure may not need a dramatic news event to ignite it. It may simply need enough buyers deciding, at the same time, that they want real metal instead of a promise. There's a tool analysts use to measure how stretched or how cheap silver looks compared to gold, called the gold to silver ratio. It simply shows how many ounces of silver it takes to buy a single ounce of gold. During silver's most explosive rallies, that ratio has fallen into the low 30s. During periods when silver is largely ignored and left behind, the ratio has climbed into the 90s, sometimes even past 100. Watching where this ratio sits and where it is heading offers a rough signal of how much room silver may still have relative to gold. But a new question is beginning to take shape among sharper analysts, one that goes beyond gold entirely. If so much of silver's future supply depends on what happens inside the copper industry, then perhaps the ratio that matters most going forward is not gold to silver, but silver to copper itself. This is a relationship almost nobody is tracking closely yet, but the connection is becoming harder to ignore. Because right now, copper is not simply reflecting global economic growth. It is showing early signs of a supply chain under real strain, tightening inventories, rising import activity, and pressure building in specific delivery points around the world. And every one of those pressures on copper eventually touches the silver market too, whether investors realize it or not. What happens next inside copper may be the clearest signal available for what happens next inside silver. Every warning sign eventually leads to a single question, one that determines whether all of this analysis matters at all. What happens to someone's money if the pressure building underneath silver and copper finally breaks loose? The honest answer is that nobody can predict the exact day or the exact trigger. Markets rarely announce themselves in advance. But understanding the mechanics laid out so far gives a clearer picture of what the setup actually looks like, and more importantly, what it does not look like. This is not a story about the world suddenly running out of silver. The physical metal still exists. It sits in vaults, in industrial supply chains, and in above-ground stockpiles built over decades. What has changed is the relationship between that physical metal and the much larger web of paper claims sitting on top of it. That relationship has grown more fragile with each passing year of deficit. And fragility, by its nature, does not stay hidden forever. Copper is the clearest signal available right now precisely because it moves first. It is not burdened by the same monetary narratives that surround silver and gold. Nobody buys copper because they fear currency devaluation. They buy it because factories, power grids, and construction projects genuinely need it. When copper's price rises sharply and its available inventories fall at the same time, it reflects real physical tightness in the supply chain, not speculation or fear. And because so much of the world's silver rides along as a byproduct of copper mining, that same tightness eventually finds its way into the silver market as well. This is the core insight that separates a serious analysis from a hyped-up prediction. The connection between copper and silver is not a theory built on emotion. It is built on the basic structure of how these metals are actually mined and delivered. When one tightens, the other feels it, sometimes with a delay, but rarely without consequence. For the business community, for entrepreneurs building long-term strategy, and for anyone responsible for protecting capital rather than simply chasing headlines, the lesson here is not to panic. It is to pay attention to structure instead of noise. Prices can be loud and unpredictable in the short term. Supply chains, deficits, and byproduct dependencies move slower, but they move with far more certainty. 6 consecutive years of deficit did not appear overnight, and they will not resolve overnight either. Every year that passes without a meaningful increase in primary silver production, or without industrial demand slowing down, adds more strain to a system that already has less room to absorb shocks than it once did. Copper's current surge may simply be the first visible crack in a structure that has been weakening quietly for years. History suggests that when this kind of pressure finally releases, it rarely does so gently. The 1980 squeeze, the 2021 retail-driven rally, and the record-breaking run earlier this year all shared one common thread: long periods of quiet tension followed by sudden, sharp repricing. Nobody rang a bell to announce any of those moments in advance. The signals were already there for those willing to look past the daily noise and focus on the underlying mechanics instead. That is precisely why this story matters now, while copper's warning is still fresh and still unfolding, rather than after the fact, when the opportunity to prepare has already passed. Markets built on structural deficits do not ask for permission before they move. They simply move, and those paying attention beforehand are the ones left in the best position when they do. The silver and copper story is still being written. But the foundation being laid right now, quietly, beneath the headlines, may end up defining the next major chapter for anyone paying close enough attention.